This is the Truffle Asset Management Podcast, a platform where you get to meet our fund managers, learn more about the funds we manage, as well as get an up-to-date view on what is happening in the world and how the current economic climate could impact you and your investments.
Good morning, everyone. Thanks for joining us on this cold winter's morning. I'm going to be taking you through a sense of how we are positioning the portfolio at the moment, how we're looking to protect capital, I guess, in an uncertain environment, but more specifically, how we're seeing the global backdrop and the local backdrop and how we think that one should be thinking about long-term allocations to really ensure the purchasing power parity of our clients' assets and making sure that we at least can navigate what appears to be an increasingly uncertain environment. So just moving on to the first slide, just to, I guess, echo why we think you should be partnering with Truffle and what are our key advantages. Well, first of all, we think we've got a very, very experienced investment team, median experience of over 20 years across the team. We've got a top decile track record of sustainable performance, which I'll demonstrate. And I think the real benefit which we've managed to leverage off for our clients over the last few years is really our rigorous and disciplined process, and then focusing on downside risk and combining that with our nimble size has really enabled us to deliver fairly compelling alpha on behalf of our clients. So just to remind you from a business perspective, we are a medium-sized boutique. We've got critical mass. We have over 20 billion of assets under management, a deep pool of intellectual capital. We're also pretty excited about our transformation journey. We are on track and are hoping to be a level 3 by this time next year. And if any of you would like further details insofar as the specifics, please feel free to contact us. Just from a process point of view, just to remind you that we are a valuation-based manager and not a value manager. And the nexus, or I guess the crux of our process, is really about identifying solid businesses. In other words, these are decent businesses which are facing some sort of temporary setback. And the comment on facing some sort of temporary setback implies mean reversion. But importantly, when we're looking at what a solid business is, it certainly has to have some reason for existence, a strong competitive advantage or a moat. And, to the extent that this can be evidenced in above average returns over time through the cycle, this is typically what we would like to see. These businesses we like and typically should have a decent cash flow conversion, given that dividends and the reinvestment of dividends are such a big proportion of the long-term return algorithm. And then very importantly, and I guess in the most recent environment, is that, the business mustn't be overly leveraged. And particularly given the specific type of business model, when it's got, potentially high operating leverage, we typically don't like to buy into businesses that have high operating and financial leverage. So in essence, we're looking to invest in a decent, solid business which is facing some sort of temporary setback. The setback may be company specific, or in fact, it might be economically induced. Effectively, we're looking for a margin of safety versus underlying intrinsic value. And as you would know, the price you pay is imperative. And certainly if we can generate or buy into assets with decent margin of safety, this reduces the probability of losing capital and then increases probability of generating the real returns over time, which our clients need. Our return algorithm at the bottom really made up of businesses which generate sustainable dividends, growing at a sustainable rate, and then buying into these cash flows and into these compounding machines at an appropriate rating, and a combination of those three factors then contributing to the real returns over time. So from a return perspective on slide 5, you can just see that the Truffle suite of products has really delivered insofar as what's written on the tin. We've delivered top decile performance since inception, and that's across all the different mandates, whether it's property, whether they are income mandates or equity, including our low equity solutions and our high equity solutions. All these respective products have done particularly well, really by focusing on those key advantages and leveraging those advantages insofar as we've been able to do that. So from an equity perspective, I guess that's really the focus of today's discussion. Our equity fund has really done well. We've had a good run over the last year. And I think, to the extent that perhaps the 14% alpha would be extraordinary, to the extent that we wouldn't be expecting this over time on an annualized basis, it was just really a function of outsized returns being on offer in certain sectors and shares, which we managed to capitalize on. But the 3, 5, and since inception returns just really showing the extent to which we've outperformed Cap Swix. And, obviously the clients that we have had invested in these respective mandates then enjoying the benefits of those, of the extent of alpha that we've generated. From a market and portfolio positioning perspective, just to give you a sense of our thinking, effectively today where we sit, there is lots of data which certainly is indicating that the global economy is in a recovery phase post-COVID. The global economic recovery is on track, but it is going to be bumpy. It is going to be uneven, but the weight of data certainly supporting and I guess indicating that we are slowly improving, while some economies improving a lot faster than others. But this, from a global backdrop point of view, I guess sets the scene for the broader discussion today in terms of how we're thinking about the world. So from a global perspective, I think the first statement to make is that central banks and policymakers are doing whatever it takes. We have got unprecedented fiscal stimulus. We've had in excess of $10 trillion. This dwarfs much of the previous stimulus measures taken in history. And in a way, this has ensured a very, very powerful recovery in risk assets from a global perspective. Certainly, if one looks at the US market, we are within a whisker of the all-time highs. And, there definitely seems to be a bit of a dislocation between Main Street and Wall Street, or between the real economy and asset prices. And I think this just really talks to the extent that policymakers have thrown whatever it takes to really ensure that we don't go into a financial crisis on top of a real economic crisis. So, perhaps that's the first real statement to make, is that asset prices are discounting perhaps a much stronger recovery, and the real economy is likely to have a bit more of an uneven, bumpy journey back to that pre-COVID level. So our base case is for a gradually improving but uneven global economic recovery, but we do expect second wave infections in the Northern Hemisphere, particularly as winter approaches. To the extent that these economies then try and open up, we must expect additional waves of infections and perhaps regional lockdowns or city lockdowns. And I think that really talks to our point that the recovery is going to be uneven and bumpy. And certainly to the extent that the US does not seem to have handled this well at all, we need to prepare ourselves for some sort of volatility, we think, going into the back end of this year. So from a South Africa perspective, unfortunately, we are in a much worse position than certainly other EMs, particularly the Eastern European and Asian EMs. And if we look at our fiscal position and, similar to the likes of Brazil, we do not have the wherewithal and fiscal firepower to be able to support the economy at a time when typically you would be expecting governments to step in and provide significant fiscal support. So I think this, together with our structural, specific issues, puts South Africa in quite a difficult position. And this forms a key part of our view, particularly in the way in which we're positioning the assets from an equity perspective. We think only a vaccine will provide certainty of recovery. So to the extent that there was a vaccine announcement, I think you would see a rally in some of the assets which have been hit the hardest. But until such point, I think the uncertainty and volatility is going to remain. But frankly, we like volatility because it provides us the opportunity, understanding what the value of assets are, to be able to arbitrage between price and value. So we think that there's a high probability of a faster recovery in global growth to pre-COVID levels than South African growth. And I think this is fundamental to the way we are thinking about allocating the equity capital. And certainly from a valuation point of view, also, I think we have a much higher degree of certainty in terms of the probability of those global companies getting their earnings back to pre-COVID levels versus many of the SA-facing businesses, which I think are struggling and are going to struggle given a lot of the issues that we've got in the economy. So from a market outlook perspective, I think first of all, I think it's fair to say that the SA equity market, excluding all these big global stocks, the Nasdaq's and the Richemonts, optically looks cheap. And if you just take a look at slide number 16, you can see this is the SA equity market forward multiple, excluding Nasdaq's. And you can see that we are still certainly below our long-term median. The sharp rise in the forward PE here is really a combination of a collapse in earnings of many of the domestic companies and a re-rating in some of the bigger globally focused businesses, excluding Nasdaq. But when we look across the board and we look at many SA companies, multiples are lower, across the board. For PEs are lower for these businesses. But I think the point that we want to make is that the operating environment for these SA companies has certainly changed versus 10, 20 years ago. It's a much more difficult operating environment, and growth is going to be structurally lower in South Africa, and returns for all SA businesses are coming down. And because returns are coming down, we think that, historically, to expect mean reversion to multiple levels, which perhaps we would have experienced historically, might not take place to the extent that we've now got the new normal from a South African perspective, where it's much more difficult for SA-facing businesses to generate positive operational leverage and to be able to grow their earnings at the levels perhaps which we've historically been accustomed to. So I think it's fair to say that earnings from an SA perspective are going to take many years to get back to pre-COVID levels. And maybe to give you an anecdote, we sat with the FirstRand management 3-4 weeks ago, and their view is it might take up to 4 years for FirstRand to get their earnings back to 2019 levels, given a lot of the issues which we are now facing. So from a COVID point of view, I think, South Africa was in a recession before COVID, and, COVID unfortunately has made a difficult situation even worse and will cause permanent structural damage to the balance sheet of the country. So to the extent that we don't have the fiscal wherewithal, and we had already grown our debt to GDP to the extent that we are now in a territory which is dangerous, makes, I guess, the long-term potential for SA even more uncertain. So if we look at the earnings just generally from SA companies, so this graph really representing the IBIS consensus for MSCI SA over the last couple of years. And effectively what it shows you is back in 2016, this blue line here was the IBIS consensus for MSCI SA company earnings for 2018. So in 2016, we were effectively expecting earnings, or let's call it unit earnings of 120, whereas what actually transpired is you had earnings of closer to 80. So I think the important point to note here is the slope of all of these forecast periods as we march out in time is sloping down. And I think that's important to recognize that from an earnings point of view, there have been continually, or earnings expectations have been downgraded to the extent that when analysts have been forecasting what SA businesses would generate, 2-3 years ago, we might have been expecting 100 or 120, and the reality is today, the actual experience is 80. So that, in essence, is really demonstrating the fact that SA Inc. companies are in a very difficult environment to the extent that we've got very low growth, and we have an environment where we don't have access to proper services insofar as water, electricity, and the increases in terms of administrative service prices are certainly well outstripping inflation. So whether it's electricity, whether it's water, whether it's rates or refuse, SA corporates and individuals are facing an income squeeze to the extent that our salaries and corporates are unable to get more than inflation increases, whereas their costs are inflating at above inflation. And I mean, perhaps just to, echo the point, since 2008 to 2019, public sector wages have annualized at 13% growth per annum versus the private sector wages at 3% per annum. So if you've happened to work in the private sector and you're only getting, 3% real per annum. Well, unfortunately, if your electricity's gone up at 12% per annum, you've had to take money out of your disposable income to meet these higher than expected cost increases. So I think in essence, this is putting pressure on companies' profit margins, and everyone out there, as you know, working for businesses are then taking steps to try and aggressively cut costs. And the two biggest costs that businesses are focusing on is leases and then staff costs. So we're going to be seeing significant retrenchments, we think, in the second half of the year. And from a South African perspective, we're expecting job losses for the full year between 2.5 and 3 million jobs to be exited. So I think the bottom line here is that, yes, optically, SA Inc. multiples might look lower than their historic median, but the operating environment has changed versus 10, 20, 30 years ago to the extent that our potential GDP is much lower, and we are now facing administered service price increases, which is putting pressure and taking bites out of our discretionary income and corporates' profit margins. So given this statement, we expect global cyclicals to outperform SA interest rate cyclicals, and given the global backdrop, which I've sketched for you, to the extent that the data is suggesting that we're starting to see a decent recovery out of certain global big geographies, to the extent where they are managing to get back to pre-COVID levels, China in particular, and China being a big consumer of commodities, ramping up its production, the demand has been pretty powerful. So to the extent that many of our domestically listed global cyclicals, the resource businesses, are getting the benefit of a weaker rand environment, and they're getting the benefit of strong demand for their base commodities, given the fact that those offshore countries have a lot more firepower and ability to support their recovery. So, valuations of these businesses are not particularly expensive either, so one doesn't have to sacrifice value at all. One is able to buy into decent quality businesses with balance sheets which are strong, with decent free cash flow yields, and where there is significant earnings still supporting these businesses on the back of this global recovery. So in effect, SA needs a decisive fiscal intervention to stave off a debt and financial crisis. There's no other way of putting it. And I think if one looks at slide 22, this just really illustrates the problem which we're facing. So SA debt to GDP, from the pre-Zuma era, so if you go back to 2008, 2009, we had 32% debt to GDP. We have almost tripled this debt in terms of the country's balance sheet, or we will have tripled it over the next couple of years. And what do we have to show for it? So we unfortunately have power stations that don't work, and lots of this capital hasn't gone into productive assets. So the way to lift the country's potential GDP is to invest in productive assets, to increase our productivity. So we've spent a huge amount of money, which is most of it has gone in the form of public sector wages. And I mentioned that the public sector wage bill over this period has inflated at 13% per annum, an enormous number, to the extent today that the bulk of the SA fiscal expenditure goes to support public sector wages as well as our various social welfare support mechanisms. So if debt continues to climb and we don't manage to bring the government expenditures under control, what happens is the cost of the interest on our debt starts to crowd out other expenditure and productive expenditure to the extent that we cannot invest in our productive capacity. And if you don't invest in your productive capacity, you can't grow and get out of this growth trap. So we really need to see decisive action from government. We've listened to the medium-term budget policy statement. There's certainly been some strong words spoken insofar as cutting the government expenditures, but the political climate currently, we think, to be able to achieve that is probably going to be difficult. And I think if we just look in the news is suggesting that there's going to be a potential 10 billion bailout for SAA. This was not in the medium-term budget policy statement. And I guess IMF and a lot of the rating agencies and everyone will be looking very closely at whether the SA government has the mettle to be able to take the hard decisions necessary to stave off, what will definitely be a debt spiral and crisis in the next 3 years if we do not cut our level of expenditure. Because I think you will see when the tax receipts are reflected from a tax collection point of view, instead of only having to borrow 300 billion rand per annum, we are now having to borrow 700 billion. So we are adding that on top of the government debt continuously. So that's why we have to cut our cloth to really match the extent of our tax receipts. So there's some hard choices coming. So I guess from an SA perspective, really what would change, give us a sense of a change in terms of the operating environment, which would be positive for SA companies, is if we saw proper structural reform insofar as many of these issues on the side of this side of the Venn diagram. So, education outcomes, certainly from an inequality point of view, all of these factors need to be addressed, but specifically putting our SOEs onto a sustainable footing where taxpayers do not have to fund uneconomic and bankrupt businesses, because that is money that comes out of disposable income, and it comes out of corporate profits to the extent that those corporates then face higher than inflation increases for services and makes them increasingly uncompetitive relative to their other global peers. Now, there are some positives. We've got strong SA institutions. The direction of government policy appears to be positive, but is lethargic. And, ultimately, this would be a big positive for the SA economy, is if we did have a crisis and we had an IMF intervention, this is effectively then when SA would hand the keys over to the IMF and they would put the necessary measures in place to ensure that we get back on a sustainable footing. But I think, unfortunately for the government at the moment, in a position where they want to retain political support, and I guess it's quite hard to make some of the choices and steps necessary, which might upset a lot of their support. So, SA future looking uncertain, and we are needing decisive action and intervention. So the data at the moment certainly would be supporting a low growth environment for SA with increasing cost pressure coming through the system, which is not positive for corporate profits. Global tail risks at the same time are increasing, and into the back end of this year, we can expect geopolitical conflict between China and certainly the US and the rest of the world to ramp up. And we think increasingly as we head closer to the election. The election probably also likely to add a big helping of volatility to the market, which we think probably gives us opportunity in terms of arbitraging between price and value. And then I think into the back half of the year, as economies open up and we go into the Northern Hemisphere winter, expect Corona and the uncertainty around the infections to probably create a bit more volatility insofar as the potential government responses to these policies. So from a portfolio perspective, in essence, if you look at our Manhattan here, for the last few years, we have been underweight many of the stocks to the left of the Manhattan, which would be the SA-focused businesses. So in other words, businesses which generate most of their earnings from doing business in an SA context. Having said that, we've also had an emphasis on bigger businesses because we feel that there is value to having the ability to change and make changes in the portfolio. So whilst there might be optically some attractive value in some of the small and mid-cap shares, unfortunately, once you buy those shares, stocks like Udecos, Invictus, AECIs, and you build big positions in these companies, it's very difficult to exit them if you need to under the auspices of, I guess, a SA backdrop, which starts to deteriorate to the extent that government doesn't take the decisive steps needed to stable for crisis. So we think liquidity is a value to having liquidity and the ability to change in the portfolio. And I think that's an important point. Second point is that the underweights that we've had in many of these sectors here are typically in businesses which we think have weaker franchises or weaker business models, and perhaps where their capital structures are weaker to the extent that they've got higher leverage, and where the management team hasn't demonstrated a good track record of proper capital allocation. But having said that, we are slightly underweight banks. Many of the banks are certainly trading at discounts to their NAVs. And from a valuation perspective, are not looking expensive versus their history and are discounting quite a bit of bad news. From an insurance perspective, we've got investments in higher LSM exposed businesses like Discovery, Liberty, and Momentum. We are a little bit more concerned about the lower LSM space to the extent that the mass market is under significant pressure. Property, we've been very negative for quite some time. We've recently increased some of our weightings during the crisis. Many of these stocks are up 20, 30%, but very much a focus on quality of assets and balance sheet. From an industrial perspective, we've picked up some exposure on some good, solid defensives. Stocks like Netcare trading on single-digit PEs, dividend yields close to 7%, where we think they should be less discretionary and less affected long-term in terms of the dynamics in the SA economy. And certainly you're paying a cheap price to buy into these particular businesses. Retail, we're still underweight. We think there's lots of pressure coming in the retail sector to the extent that consumers' discretionary income is under significant pressure and to the extent you're going to see significant job losses. Probably one of the biggest changes over the last year for us at Truffle has been moving up our exposure to the telco sector, and that's largely through MTN and Telkom. During the crisis, we started to pick up positions in these two businesses where we felt that there was significant bad news priced into two companies, and subsequently the share prices have started to pick up quite nicely. And then the other changes in the foreign and dual listeds, we exited our Richemont positions, and we also took quite a lot of profits in British American Tobacco, up at around about 700 Rand a share. And we put most of that capital, which we took profits here, into these global cyclicals, which is on the right side, including Naspers/Prosus. So I think the tilt in the portfolio really reflecting an improving global backdrop and taking advantage of the positive fundamentals of these big global businesses, some of the resource businesses with very strong free cash flows and valuations which are quite attractive. And on top of that, also, maintaining quite a hefty exposure to the Naspers process complex, which has certainly done very, very well year to date. Perhaps also just to mention, during the crisis, we took Sasol from an underweight to a small overweight between 40 and 50 Rand a share. And really, Sasol was, we felt at that point, a very, very cheap call option on the oil price, which we felt, given the global backdrop recovering, that the oil price was likely to move higher over time. We still see decent value from a free cash flow point of view in the PGM shares. Gold has also helped the portfolio. We think the environment for gold is positive. It's an uncorrelated asset, and certainly to the extent that a lot of the big global fundamentals of negative real rates, massive central bank stimulus, increasing central bank balance sheets is all very, very positive for gold. But having said that, we have recently taken some profits, particularly in Harmony, where we entered into a position at closer to 50 Rand a share, and that stock has subsequently doubled in the last 6 weeks. So I think from an overall portfolio point of view, the data from a SA perspective, and when we're talking to the corporate, certainly suggests a very difficult operating environment for SA Inc. businesses. So there is a preference for bigger businesses with scale, able to take market share from weaker players. We think weaker businesses are likely to fail. And I think those bigger businesses, like we've seen to the extent that perhaps a Fashini's is buying a jet, Edgar's coming under pressure, we think that stronger franchises can take share from weaker players and thereby generate some shareholder value for our clients. So we've tried to identify these businesses with strong franchises, which are attractively priced and where we think they're able to capitalize on their scale to the extent of taking share in a market which we are not expecting to grow from an SA economic perspective. So just from a portfolio point of view, and I guess talking to the topic headline, I guess trying to protect one's assets in an economy which is increasingly fragile and uncertain. The positive from an SA perspective is we have a nice proportion of good quality global businesses which just happen to be listed in South Africa and generate their income from global sources. And I think this provides us with the lever to still be able to protect capital, generate real returns in an environment where we are expecting the delta from an SA economic perspective to still remain difficult. And I think this is a positive. So if you look at our portfolio, we have 66% of the fund in Rand hedges. And I think to the extent that we still our positions in terms of the SA-facing businesses being pretty much dominated by the bigger domestic financials and industrials, if the data changes and we get a sense that there is, necessary structural reforms which are going to be implemented, we have the ability to change and restructure the portfolio because we are small and nimble. So I think as we stand today, I've given you a sense of our base case. The base case and the data certainly suggests from an SA perspective, it's going to be tough. Yes, prices optically look cheap, but we think that also some of them are cheap for a reason, and that earnings are unlikely to recover to pre-COVID levels as fast as some of these global cyclicals, and hence the preference for some of these globally focused stocks. So just to summarize, we maintain overweight positions in these global cyclical businesses. These high quality and rand hedge stocks are offering value. So you are not having to sacrifice value to buy into decent businesses where there's still a strong earnings underpin and decent free cash flows. SA businesses are going to struggle, but we acknowledge their valuations have started to improve. And to the extent that we have found certain SA businesses which are now attractively priced, we have moved them into the portfolio. We are very much still avoiding highly leveraged and weak business models. In an operating environment like now, when things are very tough, the ability to have scale, leverage scale, the ability to use your size to outcompete smaller competitors is going to become critical. And I think importantly, SA is heading towards a debt crisis unless decisive action is taken. So all things being equal as we stand today, we expect SA to remain in this low growth environment, and hence, I guess, the focus on some of the strategic points which I've mentioned above. From a property perspective, yes, there might be one or two stock selection opportunities, but generally the fundamentals for the properties sector still remain particularly poor. We expect vacancies to rise across all respective particular properties, whether it be office, whether it be retail, and certainly, the community-based rural centers where we've invested some capital seems to continue to trade well versus the big high street centers. But one acknowledges that there is a price for all these assets, but the fundamentals still continue to look particularly poor. And I think this really, the final point is into the back end of this year, expect volatility to remain fairly high. We think that, some of the tail risks out there likely to create significant volatility, which we think will give us the ability to allocate capital where good assets get sold down with bad assets. So I think a good environment for stock pickers, certainly from a Truffle perspective, to the extent that we have a very focused team, the ability to act quickly and take advantage of this volatility puts us in a good position to continue generating alpha on behalf of our clients. So that really is the presentation. So I just want to say thank you to everyone for joining us.
Truffle Asset Management is an authorized financial services provider. Truffle does not offer financial advice and will only give you factual information. For further details on our funds and to view our terms and conditions, please visit truffle.co.za.